You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Well, welcome back to hosting my own show. Mark Longo and I had a couple of huddle-ups the last couple of weeks answering listener questions, which are some of my favorite shows to do. But I want to actually talk a little bit about a few listener questions that we got about Tesla and Apple, the big day, the 31st of August. They both had big splits and were the topic of conversation amongst option traders all across the world. And we talked a little bit about doing protective strategies in both of those underlying stocks. And we also got some listener questions on it. Well, when we were taping Options Playbook Radio, it just happened to be the day of the split. And we actually did a listener poll to see what the marketplace thought would happen on that Monday. And the listeners of Options Insider Radio overall got it right. They basically said, they basically threw the poll, thought that both Apple and Tesla would be up by the end of the day. And lo and behold, they were. But that story was short-lived. The very next day, they both started dropping a little bit, actually quite a bit on a percentage basis. We actually saw what happened with Apple, and I just want to recap it, and I want to talk a little bit about that strategy, and then I'm going to get into our strategy for this week. When we were looking at Apple, Apple actually opened on the 31st after the split at $127.50. That's where the opening print was at. It basically went straight up from that point. It went up to 134.18. And now since that time, the low has been down to 110. And as of this taping, we are taping Options Playbook Radio. It's Wednesday, September 16th. The markets are actually open, and they are rocking right now. And we see Apple actually trading, and I'll just round it off here because it's a live quote, right around 113. So from 127.50 all the way up to 134.18, now trading at 113 approximately. All right, what happened with Tesla? Well, Tesla actually opened, and this number is pretty easy to remember, at $444.61 on that day, and it actually jumped all the way up to 500 and traded as high as 500 on that day. That would be August 31st. Since that time, the low has been 329.80. That's about where it's hit, and now it's trading at 447. So just a couple of dollars higher than where the than where Tesla opened after the split. Now, when we talked about our protection, we were just buying around the split. We had a pretty big run up in both of these underlying stocks. Once the split got announced, we talked about it being a little bit frothy. Maybe you might consider, if you owned 100 shares of Tesla or 100 shares or more of Apple, how might you use options to protect your portfolio? Now, everything that we talk about here on Options Playbook Radio is not meant to be a recommendation. And one of the things that we did look at is buying short-term puts on it. So on Friday, September 4th was our expiration. And we talked specifically about in Apple buying a put. But if you'd like to, you could collar it. In other words, I could buy a put and I could sell a call saying that I'm going to bring in some income, give up some opportunity on the upside, but we just wanted to pay for those puts because puts in general and all across the marketplace are a little bit frothy. We got the VIX trading right around 25% implied volatility. We got the futures going out to November trading up over the 30% range. So implied volatility across all the markets is just a little bit high ever since we've had the March lows that were caused by the pandemic. Okay, so we talked about just buying a put outright that gives you unlimited upside, so you still have all the upside on as you would if you owned your 100 shares of Apple, but we had limited and known downside for 1 week. Basically, from that Monday is what we're looking at. We'd put the trade on Friday before the split would be announced, or we actually did it on Options Playbook Radio on the day that we taped it, which was the Wednesday before. But with that being said, the concept would be you'd put it on Friday. It would be a 1 week long trade, and it's just going to try to get you through this crazy period of the after the split in these two juggernauts in the marketplace. All right. So we only went out a week in time, and Apple ended up actually, if you looked at it for that week, the first day we did have a big up day, and then we actually had a down day. So on Friday, Apple at the low was at 110.89, which has basically been the low since it split overall, right around 110. I think it hit that number a couple of times. So what could we have done when that happened? Well, we have the right at that point in time to sell Apple at a higher price via the put strike. But what many people would have done overall, if you're still bullish on Apple, you just wanted to, you're bullish but nervous. And I want to always emphasize this. If you are buying puts in a stock like Apple, you're still better off if Apple triples to the upside, right? And the put expires worthless. And it helped you stay in that underlying stock. So that was your goal. So what was probably the best bet if you were still bullish on Apple? Well, just sell your put. You could pick at any point in time that you wanted to sell it, but by doing a shorter term put option, that September 4th expiration, it kind of forces your hands. You got to make a decision, because that's one of the tough things when you buy protection is deciding, well, okay, is now the time that I should get out of this trade? I mean, do I really want to sell my underlying stock? So the protection helped. It protected against the downside. But you lost money on Apple. The market went down. You still had to pay the deductible on the insurance contract. You still had to pay the premium for the put option. But it did definitely provide some protection in this instance. Okay, now on Tesla, we talked about a collar. Why? Because the options were insanely priced because the stock was trading over $3,000. So at that point in time, we saw at-the-money option contracts trading over $100. So it'd be really hard if you had 100 shares of Tesla to just buy one put outright. Not to mention the implied volatility of those option contracts were double that of Apple. So we talked about a collar in that instance. So the same question would have came up. If you did it on Tesla, where would you get out at? How far out in time would you go? And I would suggest, in general, if you're doing these type of strategies, you do it for the known event, or you do it for the short term because I'm scared about September and October. That's a good enough reason right there. Those are two very volatile months in the marketplace. I'm worried about the Fed meeting. They're actually just announced today, the Fed meeting, talking about the markets. I'm worried about something else that could happen. And so if I'm buying protection, realize you're still bullish on that underlying. If you're not bullish, you really should just get out of the stock. You should just sell it. Buying protection on stocks is not cheap, especially on stocks like Tesla, for sure. And you can throw Apple into that mix, which is a little bit less volatile market overall. But think about that time period. This time period seemed to work out fairly good. And one of the things that you could have done on Apple, since we had a very short time period on the put that we actually talked about on Options Playbook Radio, it was that Friday, is actually sell that put on that Friday, close out that position, and maybe buy another 1 week long put, right? But you don't want to continue to do this because of the cost of it. And you might wipe out your protection by buying those puts, and all of a sudden the stock skyrockets back up because ultimately you are bullish. But it's okay to do it a couple of times. It's okay to go out a little bit short in time frames. Now, why did I want to go short with my time frame? Well, one of the things that you got to watch with protected puts, as opposed to, let's say, a stop order just to sell the stock if it goes down to a certain price, is that you can't really adjust your strike that easy, right? So in our instance, if we had on the day of the split, we saw that Apple closed on the 31st at let's do the open. The open was 127. So I think our put was right around 125 strike price that we were looking at. So if that was the case and the market goes all the way down, or let's say it continued on up and it went as high as 135, 140, all of a sudden that 125 strike doesn't sound that great. So in that instance, you would have to roll up or you would have to do something about it. So in my concept around this specific event in general, well, why not just do shorter term puts and then put on additional puts after you see what has happened because of the major event? And I guess I just wanted to cover that a little bit, give you a little bit more thoughts on it, because we got a lot of listener questions during the huddle up with Mark and myself. Okay, so let's get into this week's trade. We're going to look at COSTO. COSTO is going to be announcing earnings on the 22nd. And I'm going to specifically avoid earnings. And here's kind of my thoughts on the marketplace overall and implied volatilities. We looked at, on Options Playbook Radio, down at the March lows, we talked about more volatility as opposed to less volatility. And specifically, we even looked at a couple of long straddles in the airlines that actually did pretty good as a paper trade overall. But the concept was that, yeah, volatilities are high, but they really could go higher. There's just so much uncertainty in the marketplace, and specifically in a few different industries, and that uncertainty is still there, and we still see fairly decent volatilities. But what has happened since then is we had basically, if you look at the S&P 500 index, a V-shaped recovery overall, where the market just came roaring back, but the vol stayed high. We sit at an all-time high since then in the S&P 500 index, but the VIX is still stubbornly hanging around 25% implied volatility. Really hasn't came down below 20% implied volatility since those March lows. So with that said, I really don't want to mess with earnings that much. Why? Because earnings is interesting because it adds volatility, it adds premium, but the premium's already there. We're trading in an environment where we're seeing Apple still trading at 40% implied volatility. We're seeing Tesla up around 80% implied volatility. If I look at Costco, they're going into earnings. They're trading at a 40% implied volatility on the expiration that contains earnings. But the previous earnings, and once again on Costco, the expiration that expires this weekend, the 18th of September, is trading at 23% implied volatility. So that's still elevated relative to before the pandemic, before the big downturn in the marketplace. So what's one trade when you think implied volatility has proven recently to be wrong as far as compared to historical volatility, if you will. If you look back and you see, well, where was implied at over the last couple of weeks versus where the historical is on most underlyings, and I'm going to emphasize most, obviously it's not 100% the case, but on most underlyings, the implied volatility has been higher than the actual volatility. And that's actually the case in Costco. So What are we going to do about that? We know that there's a big event coming out next week. We know we have fairly inflated implied volatilities. I'm going to pull out a trade that we haven't talked about in quite a while, an Iron Condor. What's an Iron Condor, you ask? Well, an Iron Condor is just a combination of two credit spreads. You're going to do a short put spread, and you're going to do a short call spread. COSTO right now is trading at 346.29. It's up $2.38 on the day. Like I say, we are taping Options Playbook Radio. It is live. The markets are actually rocking and rolling right now, and it is Wednesday, September 16th. So how would I approach setting up a very short-term Iron Condor in COSTO? How I would want to do this is I still want to pay attention, because of earnings and everything that's going on, still want to pay attention a lot to what the expected move on the short-term expiration is. I'm not looking at the earnings expiration. I'm looking at the short-term expiration. And right now we see the expected move right about 5.5 points. Now, it's not an exact science, but what does the expected move say? It says, well, by this expiration, Friday 18th, that it's very possible that COSTO could go up or down 5.5 points. And that seems like a feasible number. Remember, it's never in regards to direction. You can kind of think of it as the over-under going into that expiration date. So if I'm going to do an Iron Condor, I want to pay attention to that. I want to go at least 5.5 points out of the money. I want to say, okay, we want to be further out of the money on these option contracts than what the marketplace is expecting could happen. And COSTO, with the stock at 346, that means if I add 5 points to it, that would be 351. Well, they happen on the call side to have a 352.50 strike, $352.50. So we're going to avoid earnings. So we're only doing a few days. This is going to be a short-term speculative trade, just hoping that the markets will stay chill, especially COSTO, and wait to see what happens with earnings. Today it is up $2.77, so that's worth noting because that's a fairly decent move as compared to what we're expecting in our Iron Condor. It's a half of the move, but we only have a couple of days that we need this thing to live for us. So if I look at the 352.50 call, that's trading on the bid at about 64 cents. And then we're just going to go 2.5 points wide. This is just a paper trade, as always, not meant to be a recommendation. So if you want a little bit bigger credit, you could go 5 points wide, but we're just going to go 2.5 here. And then if we go 2.5 points up on the COSTO September 18th expiration, we see that the asking price on that 355 call option is trading for about 41 cents. Now, by itself, that's not a very good credit overall. It's 2.5 points wide, so it's not a massive amount of risk, but you're not really bringing in a ton of credit. So in order to get, once again, outside of the expected move on the downside with the market trading at 346 approximately, we're going to look at selling the 340 put. Once again, over 5.5 points to the downside. And that 340 put is trading at 56 cents on the bid. And then we're going to go 2.5 points down. We're going to buy some protection. And that's trading at about 34 cents on the ask. All right. Now, I gave you a bit of ask prices overall. But one thing that's great about an Iron Condor is that your risk is only going to be 2.5, even though you're doing two spreads. Why? Because the concept is, as far as I know, markets can only go in one direction. They can't be down and up at the expiration date. So only one of these spreads will be at risk. So we get both credits, but only one spread can hurt us. So in this instance, if we look at the midpoint of this trade, we're seeing the midpoint trading at about 47 cents. So combined, we're bringing in a decent credit for a 2.5 point wide spread, being that the maximum that this thing could trade for would be 2.5 points. So you minus, let's call it 50 cents on the bid, just to make the math simple. And you right now you're bringing in a 50-cent credit on a 2.5 point wide spread. So you have 2 points of risk overall. The expected move is about 5.5 points. So you have a 10-point landing area, basically, even a little more. If you look at the strikes that we bought, that we really feel comfortable with on this trade. We hope that COSTO will settle down and the volatility will decrease on the month that on the expiration, I should say the weekly expiration, not the monthly anymore. Weeklies are a little bit more of the theme nowadays, but on the weekly expiration, we hope that volatility will slow down on that September 18th expiration. And then we don't care what happens going into earnings on COSTO because this trade will already be done and over with. All right, so that's the concept. And now on Options Playbook Radio, everything's just meant to be a learning experience. So here's what my challenge would be. Think of underlyings that you might want to do this in. Costco's a fairly highly priced underlying, $346. We have earnings. It's got some volatility, but some predictability. It's still a retailer. They've been a little bit hot recently, but they've also been kind of frothy. Maybe it's time for them to chill down a little bit. So a little bit more expensive underlying. They're going to be announcing earnings next week. Let's see if they'll settle down. Iron Condors might be a speculative way to try to take advantage of the fact that we have increased volatility across all markets overall. So let's summarize the trade. Costco is trading right around $346. We're going to look at an Iron Condor. We go out and sell the 352.50 strike call, and at the same time buy the 355 strike call. Down on the put side, at the same time, we sell the 340 strike put, and then we buy the 337.50 strike put. Our goal is to get this done for a net credit at fairly close to the midpoint, right around 50 cents. Don't forget, you got to add commissions. You got a four-legged trade here, so that will affect the bottom line of this trade. And we have only 2 full days to expiration. Well, the market's still open, so you got all day Thursday, all day Friday, and they expire at the close on Friday, September 18th. That's it for this edition of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. You can actually follow me on Twitter. I've been tweeting a lot more recently at Brian Overby. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.